Good evening, and welcome to the Bullcast Podcast. I'm Katie Pickler, and with me is my ghouly host, Cord Winsett. And there's the opening chime. So, guys, we are kicking off a fun little spooky episode.
Yeah, we're dead smack in the middle of October, baby.
Dead. Love it. So, we're going to talk about part 2 of mortgages and home debt. And we're going to throw a little spooky spin to it.
Sure, absolutely. Because, you know, it's October. It's Halloween time. Haunted. Everything's scary. Everything's spooky. So, good topic for a top 5 this week. Feels like to me, maybe top 5 real haunted houses.
Yes.
Yes.
So, last time we did pop culture iconic houses that we like. This time we're going to actually do real haunted houses. Not the little fun ones you pay $5 to go through or whatever it is, but this is houses that are actually haunted.
Houses of legend.
Yes. So, this is my favorite stuff. I love it. Number 5 for mine would be the Franklin Castle in Cleveland, Ohio. So watch out, Cleveland, Ohio. Death has been all around this house, this castle that was built in 1865. Just tragic history. People have bought it and tried to restore it, and every single time it ends up being fires, and they even found baby bones in a corner.
Wait, no. Okay, listen, that's seriously like baby bones?
Yeah, like a skeleton of a baby they found when they were renovating. I'm just reading the facts. I'm not saying I lived in this house. Okay, come on.
No, but I'm looking at your face, and you would. You're getting all excited about these things.
I may visit it, but okay. My number 4 actually is Texarkana, Arkansas. I passed through there when going to the Cowboys games. Go Cowboys. This house was actually the Phantom Killer. He took his victims there. And 5 people were reported killed, 3 wounded. But what's crazy about this is when I was researching, the FBI actually published articles that were found a couple of months ago. In 2020, this was released. And it turns out they actually never found the guy that killed all these people. They arrested 400 suspects, but...
400 suspects?
But it was in 1946.
Out of 400 suspects, they couldn't nail it down to one person?
Yeah,
or maybe even 40.
Texarkana.
Let's just go with, 10%.
Number 3 would be the Hot Mansion in Brush Park, Michigan.
Hot. So it's of high temperature?
Sure. Well, I mean, it actually was an upscale brothel in the 40s.
Oh, my Lanta.
So, there's something about brothels and kind of spooky air about it. I guess it's because there was a lot of sin around that, and I don't know, but there seems to be a common
Hey, listen, I've never been to a brothel. If you have experience in that area, then I'm going to take your word for it.
But it's just the Orpheum Theater in town used to be a brothel at one point. I think a lot of old historic buildings were a brothel at some point.
Well, sure.
But anyways, this one that's in Brush Park, Michigan, it actually cameoed in the 2016 Batman vs Superman: Dawn of Justice.
Aw.
Yeah, and so it's a really cool looking spooky building. They did find dead bodies in the basement, but it was just their torsos and the chest of the victims that were marked with a perfect circle.
Katie.
So,
what is wrong with you? I
like spooky stuff. My number 2. Okay, we're taking it down to the Big Easy. New Orleans. Mm-hmm. New Orleans is definitely a spooky place. So this place is the Lalaurie house. It was Madame Delphine Lalaurie, and she orchestrated a torture chamber for these slaves that were in her house. And Nicolas Cage actually ended up owning this house at one point, but then he had a lot of bad voodoo around him.
Yeah.
It got foreclosed. It was featured in American Horror Story Coven. And so Madame Delphine was actually one of the characters, but she's a real person as well.
So Coven, the witch season, that was which character was this? This was
Kathy Bates.
Kathy Bates.
Yes, and so
I did not know that was based on a real person.
It's right there in the heart of New Orleans, so you probably walked by it. Yep. My number 1 is another New Orleans house. It's the Buckner Mansion. This one was in Coven as well. It's the school that the girls are a part of. And this is supposedly haunted by Miss Josephine from the Civil War. And she often has smell of lemon as she's constantly cleaning the house. You can rent it and stay for one night for $4,700.
Interesting.
So I'm starting to save that's my next investment account, is saving so I can stay in this house one night.
That is a bit pricey, yes. Well, that's a good top 5, and you ended on a pricey bed and breakfast, so I'll start with a bed and breakfast. My number 5 is the Borden house.
Lizzie Borden.
Yes, absolutely. Up in Massachusetts. This, of course, Lizzie Borden is famous for having been accused of killing her father and her stepmother with an axe, actually a hatchet, in the Borden house. She was put on trial. She was acquitted, and she ended up living out her life in the town where she was accused of murder. She never moved out of there. Nowadays,
there was some awkward street walking by.
Yeah. I mean, I think she was definitely ostracized. But nowadays, the house has been claimed by some different paranormal, quote unquote, experts to be haunted. There may be some spirits of Andrew Borden still wandering around. So interesting, fun. My number 4. The Bell Witch Cave. Okay, so this is the reason this made my list, is because it's Tennessee.
Yes.
And technically, it's a cave, not a house. This was John Bell moved his family to Tennessee, bought some land, farming the land. They started being haunted by this spirit, this evil spirit. Invited people from the town to come in and check it out, and people were like, "Yeah, you're definitely haunted." And like the longer it went on, it wasn't just a couple of little things. He and his daughter Betsy kept getting like haunted by this evil spirit. And the longer it went on, the more powerful supposedly the spirit became, and eventually was able to actually
feeding off their fears.
Yeah,
yes.
Communicate with them. And basically the spirit was like, yeah, the reason I'm doing this is because I want to kill John and break Betsy up with her, break up her engagement. And once I've done that, I'll leave. And a little while later, a couple of years of this haunting going on, and the Bell Witch, she killed John, and then Betsy broke off her engagement, and the Bell Witch went away. So, but people claim to this day, they claim that even to this day that the Bell Witch still haunts the area, and that if you were to go stay out in the field, you may encounter her, and so that's freaky, and I would rather not. Number 3 is the Biltmore Estate, and actually this is my number 3 mainly because the haunting is kind of it's listed if you Google most haunted places, it's listed as one of the most haunted places in America, but really the backstory behind why it's haunted is kind of weird. And the main reason this one's on my list is because it's beautiful. This place is a palace. This is an American palace built by George Washington Vanderbilt of the Vanderbilts, and it is beautiful, and I just want to own it. I mean, I would put up with the haunting at this place because it doesn't sound like it's really all that scary.
Well, it's supposedly the wife, isn't it? Vanderbilt's wife that's haunting, and the thing is there's a lot of those historical places, like heck, the place I got married in Memphis, the Orpheum Theater. Any building that's around for a long time has spirits, and I think a lot of times people think hauntings and spirits, they have to be bad, but the famous one at the theater here is a little girl that just plays little tricks, and a lot of times these spirits only show themselves to those that believe. And so at the Biltmore, I'm sure it's just kind of the cleaning crew or the management that there's late, not when all the tourists are there.
Mm-hmm. Yeah. So I'll move there. I will give you that one. Number 2 on my list is the Lemp Mansion. Now this is in St. Louis. This was a house built by, I think his name was William Lemp, and there was a William Lemp Sr., a Jr. Anyway, there are a lot of Lemps, and he started a brewery in St. Louis. It was one of the biggest breweries, the Western Brewery, prior to Prohibition. It had Falstaff beer, and was really a big deal. Brewery failed because of Prohibition, and the Lemp family had some tragedies after that. Lost sons early in life to death. Several people committed suicide.
I think the family was kind of plagued a little bit like they talk about with the Kennedys, that there's just bad vibes that follow
bad
them.
Vibes all around.
All
so
generations.
their family mansion is haunted to this day, supposedly. Number 1 on my list is the Winchester Mystery House. And I mean, if you haven't heard of this one, you probably have seen something about it. You just didn't realize that it was called the Winchester Mystery House. This house was built by the widow of Winchester, the guy that started the Winchester Rifle Company. So he died, left her a bunch of money. A spiritual advisor told her that she needed to move away from the east, away from, I think, New Haven, out to the west, to build a place for herself and all the spirits of the dead people from Winchester Rifles to live. And so she moved out to California and built a house, and it's giant, and she just kept building on it and building on it and building on it until the day she died. And supposedly, obviously, it's haunted by all of the ghosts of people who were killed by Winchester Rifles.
Fun.
But the house is crazy. The house is like nutballs crazy. So there's that. That's my number one.
Very cool. Okay, so really this one was just a fun one. But when you're thinking about a house, you know, if you need to bring the Ghostbusters in and inspect and make sure that it's not haunted, which actually, when my parents built their house many eons ago, my brother insisted, a little 5-year-old boy insisted that the Ghostbusters actually come in and inspect the new built house to make sure there was no spirits there. So
that it was newly built.
You know, that's what they don't tell you. They tell you about pre-approval and credit scores, but Ghostbusters, add it to your list if you don't want to live in a haunted place.
Absolutely.
Okay, let's get to the meat of this. So last episode, we talked about renting versus buying.
Yes.
Really understanding your budget, figuring out kind of what's going to fit in your budget, and understanding, you know, wants versus needs, and making sure you're getting the location and the house and all the different elements of it that you need. We obviously all want to dream, and I think you want a Tony Stark's house. But in reality, we've got to be real with ourselves, what works with our budget and what we actually need.
Yes, and what fits your budget, and then obviously we did go over a little bit of, we teased today's episode what it takes to get a mortgage nowadays, and what the reasons are behind that, what the history is that led up to where we are now. So today, you've decided to buy a house, and now you just got to pay for the house.
Yeah. And we're actually going to have a guest on this episode, Nancy Krahl with Bank of Bartlett. She's going to talk to us a little bit about kind of a little bit of the confusing part, the underwriting, and really the process of what you would expect when you are talking to a bank about getting a mortgage. And
we can give you a little bit, but we definitely want that expert in here. So we're gonna build you up to the point where the underwriter would actually come in. We can give you the basic information, and then I'm going to ask Nancy a couple of questions too.
Yeah. So okay.
So what's a mortgage?
What's a
How
mortgage? It's simple. It's you are working with a lender and allowing you to borrow money in order to purchase real estate.
Yes.
Just in simple fact of that.
Bing, bang, boom.
Banks aren't going to lend you money for free.
No.
You know? So you're going to have to impose some interest. And usually these consist of monthly payments, which breaks down between your principal and your interest. And you're going to be paying off this mortgage, whatever you said, if it's a fixed rate, adjustable rate, there's all different kinds of options and all different kinds of mortgages out there that can kind of get a little confusing. And so that's where we're going to hopefully, by the end of this episode, you'll understand the different ones that are out there. But I will tell you, with a lot of things, Court's favorite phrase comes into it. It depends. It depends on where you live. It depends on what you're looking for, who you are with your background of your money, what kind of banks you're working for, on what mortgage is best for you. And that's where I got to plug it in. A partner like a wealth advisor like us, or anybody, is a good idea to talk about, because buying a house is the biggest financial decision you will make of your life. So don't just go into it willy-nilly and go, I'm going to, today I woke up and I'm going to buy a house. More than likely, you need to think a little bit about it. This is not just going and having an impulse buy. This is a big deal.
Yeah. Well, yes. That it's huge. It's huge. Huge.
Okay. So let's start with some terminology around mortgages.
Okay.
Amortization.
Amortization.
Yes.
Yes.
So what this is when you say, at this point, we've decided what our mortgage is and you've got your monthly payments figured out. So amortization is what's actually going on with that. Part of each monthly payment will go towards paying interest to the lender, while another goes towards paying down your loan balance, which is the principal.
Right.
And so it refers to how many payments are broken up over the lifetime of a loan. During the early years, you're actually paying a higher portion towards interest, because you think about it, you're looking at it in that first year, you've got the full amount of whatever you borrowed. So if you borrowed $400,000 that first year, you're paying interest towards that. And then every year it drops down and you're only paying interest towards $200,000 that is left or $100,000 that's left. So look at it that way, that it's kind of just piece by piece being changed up over the payments. So yes, your first year, you're mostly looking at interest.
So the part of the element of an amortized loan is equal payments over a period of time. You want that interest rate that you're paying, because you're paying interest on a higher amount of principal at the beginning of your loan. Then to pay that much interest, you have to pay, if you want an equal payment, if you want your payment to be the same over the course of the loan, then the amount of interest you're paying up at the front is more because you owe more. So more of that equal payment is going to go towards your interest than is going to go toward your principal. But as you're going along and you're slowly paying down that principal, you owe less. You're responsible for less interest because you're paying an interest rate on a lower amount of principal now as you've paid the principal off. That payment is staying the same. Still, you're paying the same payment, but more of the payment will start going towards your principal as you move along, and less of it will have to go towards your interest.
Like, I know every website is different, but I know with mine, there's actually a way that you can set it. It's like, here's your monthly payment, or you can pay extra towards principal or interest. And so that's where when people talk about they're paying a little extra on their mortgage each month, you want to pay it towards that or that principal. You want to pay it towards that overall loan. Yeah. But that's something that's a horse of a different color. We're not getting into paying extra. Right now we're talking about just figuring out what your mortgage is going to be and paying what you're supposed to pay, not any extra at this point.
It's a loan of principal. They're going to charge you interest.
Yes.
They're going to have you pay it back over a course of a number of years, and those payments can be equal and spread out over the course of the however many years it is, basically.
Yeah, so another term you hear a lot around mortgages is down payment. And this is simple. This is just the money that you need to have available to pay up front when you're purchasing your house. And the size of what this down payment needs to be depends on what kind of house you're getting, what kind of loan. Typically, it's going to be 20% of the overall amount is what you're going to have to come up with. So a lot of times when we're talking about with our budget, you're not saving up. If you want to buy a $500,000 house, you're not having to save up the $500,000. You're needing to save up that money for that down payment.
Yeah, and so I guess a good question that sort of begs is, who makes those decisions? Who decides how much you're going to need to put down, and who decides what your interest rate is going to be, and how do they make those decisions? What's the process? Who are these loan officers or whatever that make these decisions, and what the process is? What is the process that they go through to make them?
Well, Court, that's why we're bringing Nancy in, for you to kind of chat with her and see, how does this process work? How is it decided? And why is it that when I first bought my house, everybody was joking of, let's see how long your bank actually holds on and before it gets sold. So that's what I'm hoping you can figure out when you chat with Nancy.
And away we go. Welcome to Bullcast, Nancy.
Well, thank you. I'm excited to be here. Happy Halloween.
Yeah, you're here for our spooky episode. So I hope you can be very scary on demand.
Oh, definitely.
Nancy Krahl, ladies and gentlemen, she is a bank mortgage officer, a loan originator at Bank of Bartlett here in the Shelby County area. What we are going to do today is, Nancy, I'll just tell you, we're right in the middle of defining some terms, and we're putting you right between down payment and underwriting. So you'll be able to, I'm sure, discuss with us all of the process of somebody walking into a Bank of Bartlett branch and what they're going to need to bring to you so that they can get pre-qualified, go out and find a house, come back to you, say, hey, I found a house. Hopefully you're gonna be able to walk us through just exactly what it feels like for that person to start from talking to you for the first time. What do they need to bring and all of that, right up until The underwriters are done with them. We can make that scary for sure. And then when the underwriters are done, they close on their house, and boom, we're out of here. Why don't you start with a guy named Joe walks into your branch, walks into Bank of Bartlett branch. You work at out of the Wolf Chase branch. You've got an office, and he goes up to the desk side lady and he says, "Hey, I want to buy a house. Who do I need to talk to?" And the desk side lady says, "Well, let me introduce you to Nancy Krahl." So what are you going to ask him for?
His driver's license, and pretty simple. We just need last 2 years tax returns, including W-2s, last 1 month pay stubs, last 2 months bank statements, and if he's got an investment or a retirement account, then the last quarterly statement.
All right. Okay. That's probably good information for somebody to have, because that I don't know about you, Cameron, but I don't just keep all that stuff in my pocket. I'd have to gather all that stuff together, right? Cameron's nodding his head. He's saying definitely. Okay. So I give you that paperwork. Let's say hypothetically, I give you that paperwork. I've got a job. You look through all of my paperwork. You see that I've got a credit score of around 660. What are you going to tell me? Am I going to be able to pre-qualify?
Sure, you should qualify for FHA.
Awesome. Okay, so I'm pre-qualified for an FHA. Do I get like a stamp on my hand, or a letter or something?
I can give you a stamp on your hand if you want. I'll give you a pre-qualified.
Okay. And so I get my pre-qualification letter. I'm going to go out. I'm going to find my dream home. Once I found my dream home, I'm going to come back to you and I'm going to say, I found it. It's $100,000. What kind of down payment am I going to need?
You're going to need your 3.5%.
3.5%. So I've got 3.5%. Can I just like bring in a bag of cash, or do I need to have
It's got to be sitting in a bank account for a couple of months.
Okay.
That's why we need the bank statements.
I got you. Okay. So I've got to be able to show that I've had that cash for a while. You mentioned earlier, before we started this conversation, you mentioned something about 4 C's to me. So what are those 4 C's?
Capacity, credit, cash, collateral.
Okay. Capacity. What does that mean?
Your ability to repay.
My ability to repay.
You have to have a job. And we factor in your debt to income ratio.
You got to have a job.
Within limits, so you don't spend too much.
You got to have a job, and you got to have your income. You got to have a good enough income that you can pay all of your debts. Now, what kind of debts? We're not talking about like the cable bill and stuff.
That's correct.
Okay, it's just
the stuff that shows up on your credit report.
Okay, all right.
And the new house payment as well.
Well, obviously,
taxes and insurance and mortgage insurance.
Okay, so next would be credit, right? What is that?
We're looking for at least 640 credit score, and also clean credit too. If you have any late payments, collections, we need a letter of explanation explaining that.
Okay. So credit is more than just credit score. It's more than just that number. It's your credit history.
That's correct.
Great. And also, I know you mentioned something to me about a history of, like, for instance, if I'm coming to you for a loan and I've been living with my parents right up to now, I don't have any history of paying rent or anything. Is that going to affect it at all?
That's called payment shock.
Yeah. Okay. And you don't like that, right?
We don't like a big payment shock, obviously. You know, you don't want to go from paying $0 a month living at home with your folks to a $1,500 mortgage.
Well, that makes sense.
So you want to live within your limits.
Yeah. Okay. Next is cash. And we've kind of already hit on cash. Cash is that down payment, right?
That's proof of funds.
Okay.
Have to be in a bank account. Or in a retirement account. They can also be, in the case of the FHA, they can be gift funds from a family member.
Okay. But again, just to be clear, I can't just walk in with a bag of dollar bills and hand them to you and say, here's my cash.
Absolutely not.
Ah, darn it. Okay. And then finally, we have collateral. Now, what do you mean by collateral?
The house you're buying has to appraise.
Okay. So that would probably be one of the next steps, right? I'll come back in. Nancy, I found my house. It's great. It's my dream house. And you're going to take all of the stuff that I gave you before, and you're going to take, here's my contract. I got a signed contract. I made an offer and they accepted it. So you're going to take all of that. And what are you going to do with it?
I'll start inputting it into your loan file. And I'll look your rate. And then we'll send you initial disclosures within 3 days.
Okay.
And a loan estimate, so you know what you're getting yourself into. So you also know what you have to bring to the table.
I mean, because this is a big deal.
This is a huge deal.
Yeah. And then I guess at some point you got to move it on down the road, right? You're not the only person that works on this thing.
And then it goes to processing.
I got you.
Once you sign your disclosures, I can send it to processing.
Okay. And they're going to
Verify everything.
They're just going to make sure I'm telling the truth. They're just going to make sure I'm telling the truth. And you said something about the collateral, that the house has to be appraised for the amount that I want to pay for it. So I assume we're going to have to order an appraisal, right?
That's correct. And that's where the processor steps in. So once I turn the loan over to the processor, we'll order the appraisal, we'll order the title work.
Okay. And so they come back to you at a certain point. And now when you hand it over to the processor, am I done with you? Or you like shoo?
I'm your point of contact from start to finish.
Start to finish. Okay. So
I'll work with a processor on the rest of your loan until it goes to underwriting.
Ooh, underwriting. That's the word. That's the next word on the list that we're quote unquote defining. It always reminds me of an undertaker. I don't know. Underwriters sound pretty scary.
No comment.
But it's going to go to underwriting probably how long
About
before?
a week before.
About
closing.
A week before the
3 to 5 days before closing.
Okay. And the underwriters, they're basically sort of have to sign off on yes, this guy is a good risk. They
review and approve.
Okay. So there you go, ladies and gentlemen. Underwriting, all it really is a terrifying person who holds my entire life and dreams in their hands. They decide if I am worth the risk of loaning me the money. Fantastic. Okay, so it's gone through underwriting. They, like you, have met me, or they probably don't ever actually meet me.
They never meet you.
But, on paper, I look like I'm a heck of a guy. And so they approve of this loan. It's going to, I guess, what's the next step? Let me see.
We prepare loan documents.
Okay.
And we send them to your closing attorney that you picked out. You already have an appointment set up.
Who did that?
Time.
I
did.
Oh, great. Mm-hmm. Man, she is like a one-stop shop over here.
You have one more thing to do. Well, actually, you have two things.
What's that?
You need to wire your funds.
Okay. Now
that would be your down payment, and if you have closing costs that the seller isn't paying.
Okay, so if I don't make the seller pay my closing costs, then I got to pay those when I put the down payment down. So that's all getting paid right up front.
No, you put earnest money when you go under contract, but you have to bring the funds to closing. That's called cash to close.
Okay. So
but
whatever,
it's not actually your cash. You're going to wire from your bank account. Leave your bag of money at home.
Okay, but so let's say I put down to be clear, when I made my offer, I gave $1,000 in earnest money.
That is earnest money.
My down payment is $3,500. It has to be 3.5% of $100,000, so it's got to be $3,500. Is that $1,000 that I put down is earnest money? Is that part of the $3,500 down payment?
That's correct.
Okay, so I'm going to have to wire over $2,500 more to cover the full down payment plus whatever my closing costs are, unless I got that buyer to pay my closing costs. And by gosh, I'm going to get the buyer to pay my closing costs.
You mean the seller, because you're the buyer?
That's right. You got me. Wow, you
tried to trick me. Trick or treat.
No. So, okay. Now I got to go into the attorney's office and I got to sign my papers, and I'm signed and I've wired the funds and everything's good. Did I miss anything?
Keys.
I got to get the keys to the house. So now I have the keys to my very own dream house. And
then you have to make your first payment.
I gotta pay for it. Golly, I can't get anything past you. Okay, so I'm gonna pay for the house in monthly installments over the rest of my life, or at least
only for 30 years. So hopefully you'll live that long.
I don't know. We'll see. Okay. Well, I guess we should cover real quick. Let's say Joe Blow walks in and you said, well, I think you should qualify for an FHA. What if he wants that conventional? What is he going to need to do to get that conventional loan?
Well, I think he needs to see a credit counselor.
Bring that credit score up.
Bring the credit score up. The higher the score, the lower the interest rate on conventional.
Okay.
The lower the mortgage insurance.
Right. So if you have a higher credit score and you want to put down less than 20%, if you put down anything less than 20% on a conventional loan, you're going to have to pay that mortgage insurance, that private mortgage insurance, or PMI. But if you have to pay that PMI, a better credit score means lower PMI.
That's correct. And the lower and the higher the down payment, the lower the PMI.
Okay. All right. Fantastic. That is everything. Let me ask you one question for Katie, because she really, really wanted to know why people were making jokes about her mortgage being sold by the bank. Somebody said to her, so I wonder how long it's going to be before the bank sells the mortgage. So what is that all about?
Most banks have investors that we transfer servicing to.
Okay. Most banks have investors. There are people out there that will actually buy these loans, buy these mortgages from the bank because they see it as a revenue stream.
That's good.
Okay. All right. Fantastic. Well, Nancy, it has been amazing having you here today. I hope you will come back and talk to us some more about all of this later on down the road.
It would be my pleasure.
Fantastic.
Thanks.
And Katie got the answer to her question too. So Katie, I'm throwing it back to you.
I am so glad you chatted with Nancy, because that's something that we send it to the experts and get them to tell us what's going on. Let them tell us about this whole underwriting process and stuff. But
well, we still, I mean, we haven't even gotten through all of the terminology.
No.
That was like a little detour just to go down that one rabbit hole. But we've got a couple of other words, a couple of other terminology things that we want to cover with you. So what's next on our list would be
escrow.
Escrow.
Yes. So this is something that most loans include escrow. And a lot of the mortgage companies, it's, that's a requirement.
Yeah.
Because they're trying to protect their investment. But what an escrow account is it's set up and it's usually roped in there with your mortgage, and it's
part of your payment.
Yeah,
part of your monthly payment.
And it pays for the property taxes and the homeowner's insurance. Mm-hmm. And so no interest is earned on this escrow part of it. But as a homeowner, if you get that letter in the mail that says your property taxes are due and it's that big old ugly number, you go, oh, how am I going to come up with that much? That's why it's a part of your mortgage, that you're paying towards that every month. And so you don't have that big old sticker shock.
The mortgage company's setting that money aside. They're basically putting it into account. And they're like, yeah, we're going to hang on to this and make sure that your taxes get paid at the end of the year.
Yeah.
Which is why it's a protection for them, because they're making sure that your taxes are paid so that the government doesn't come in and foreclose on your house. Absolutely. Because of unpaid taxes. That way, their investment is still bringing in their money. And they're making sure that your house is insured so that if it burns down and there's nothing left of it, that there's insurance that'll cover that. Because if there were no insurance to cover it, then they own nothing. They have a lien on your house, which doesn't exist anymore.
Yeah, exactly.
So the escrow account protects them, but it also is going to be two things that you don't have to worry about because it's taken care of.
Yeah. And a side note on it, it's one of those that a lot of people, I know there's a lot of people out there that say, oh, I want to get rid of my home debt and I don't want to have a mortgage anymore. Well, no matter what, we said last time, there's going to be a cost for where you live. Mm-hmm. So even if you were to have paid off your entire loan and have no per se mortgage payments, you're going to still have to pay these home insurance and these taxes. Mm-hmm. So there is still a cost. And that's what I think a lot of people forget about. But remember, once the loan is paid off, you still have to pay.
Yeah, absolutely. Okay, so let's talk. Let's pretend that we haven't paid off our loan yet. So we're still talking about that loan payment.
Yes.
You got the principal payment and the interest payment. Mm-hmm. So we got interest rates. There are a couple of different kinds of interest rates that you might have when you have a mortgage. So why don't we talk about that?
Yeah, so you got interest rates. Fixed rates stay the same through the whole length. Mm-hmm. And a lot of times when you hear mortgages, you've got the 30-year fixed, you've got 15-year. And what comes around with the whole interest rate is obviously what the market's doing. Mm-hmm. But it's are you doing a 30-year? Are you doing a 15? Because then that'll play into it. But then also what you can qualify for with your interest rate. What is your credit score? Mm-hmm. Who are you as a person? Like what can we offer you? And so with that, you've got fixed and adjustable. And so with fixed, you're locking it in. So, right now, 2020 interest rates are looking really great. And that's a lot of people are jumping on houses. And I know, April, I thought I was getting a great rate with 3%. And now that's crap.
Yeah.
Now people are getting 2.5%. And, going back to David Pickler, he made a comment about his first home was 12%.
Yes.
So that means that he was paying a lot higher because the house he bought, there was the cost of that, but then you got the 12% interest.
Well, and so that's fixed unless and until if you've got a fixed 12% interest rate, then unless and until you refinance, which we're going to talk about at the end of the episode, and unless and until you do that, it's fixed. So if the bank locked you in at 12, then they're not going to just come and say like, oh, hey, let us give you a lower rate. You're going to actually have to go and get that. So that's something to think about. But that interest rate, one of the big things that interest rate affects is, like I said before, it's your interest rate. You're paying interest on the total amount that you borrowed, but it affects that interest payment that you're making affects that monthly amount that you can pay.
Absolutely.
So it requires that you're paying more towards your interest, which means you're paying less towards your principal.
Towards the loan, yeah.
And ultimately, that affects how much house you can actually afford.
Yeah.
Because, you
look at the interest rate, and that's your charge. That's your fee for borrowing this money.
Mm-hmm.
Yeah. And so that's the thing is a lot of times I think that people forget about it and they get a low interest rate and they're buying a house that's way too big for them. And it's only buy the house size that you need, and make sure you understand with your interest rate what that cost is doing to your monthly payments. Mm. But then on the flip side of that, you've got adjustable.
Yes.
And so adjustable is good and bad. So it is fixed for a shorter period of time. It may be 5, 7, 10, whatever it may be. And so that means it'll stay stable, stay fixed for that time period. And then after that, it's going to start fluctuating and going up or down depending on the market. So that means you have no idea what your payments could be. Your monthly payments are changing from year to year, and it's right for some borrowers, but then it's got some bad side to it too, because you don't have that certainty of knowing what your payment is. When it's good is, okay, say right now, rates are great. Rates are low. Mm-hmm. So you want to, as soon as you get that, you want to lock it in. But if you happen to feel like, the rates were at 4, but you feel like they're going to go down, you may end up doing an adjustable rate because you are confident that interest rates are going down and that it's going to pay off in the long run for you to have this adjustable interest rate.
Well, and I know that one of the things that certainly affects an interest rate, what kind of interest rate you can get for a fixed interest rate, is your credit score. So let's say your credit score isn't awesome, and you can't lock in a really low fixed rate. Will it be easier to get an adjustable rate if you have a lower score? Does that play into it at all?
Yeah, absolutely. That plays into it. And it's one of those that if you're trying to build your credit score up, like something's going on, get that adjustable rate. And then down the road, you may be able to refinance, which, we're going to get into all about refinancing. But then that gives you the opportunity to jump on the opportunity to get maybe a fixed rate now.
Mm-hmm. Okay, so just to be clear, if your credit score to a great degree is going to drive what kind of interest rate you can get. If you've got a great credit score, you might be able to lock in that really low interest rate. But if your credit score isn't so good, you either are going to lock in a higher interest rate and you're going to pay a higher interest rate because your credit score isn't as good, or maybe possibly you can get that adjustable rate for now, for the time being, make those payments, hopefully, improve, and then maybe you can lock in something better down the road. That's kind of that idea. I just want to make sure that I hit on the fact that, one of the big things with the interest rate is, we discussed this with Nancy, some of the things that they're looking at, well, how much are they going to loan? And they're looking at, well, what is your credit score? And they also are going to be looking at not necessarily what your income is, but do you have a source of regular income? Is it a steady stream of regular income that you can prove?
It's not that your assets necessarily, because, someone who may have a bunch of assets laying around and have plenty of money to buy a house, but if they don't have that regular income, they don't have a job, then sometimes you can run into roadblocks because you have to prove that, yes, I've got the money. I can pay for this. I can do this. So it is tricky, but remember, again, it's that all of this whole process is in place because of past mistakes. And it all ropes into your budget and making sure that you understand this is not supposed to be a simple process. It can be smooth, but it's one of those that you may have to go back to the drawing boards depending on what your interest rates you get and what kind of loans you get. But that's where you look at your budget and you make sure you're working with that total debt of the home should be 36%. That's what you got to work with. So
No more than.
Yes. You don't have, don't be an overachiever. You don't have to do the 36%. But it's one of those, you need to understand you've got that in your mind of what you can actually afford, what those monthly payments can be, because it may be that you have to readjust midway through and be like, hold on. We can't go down this path because that's going to change my payment. I need it to be this. And then you go back to the drawing boards, work with your bank, outsource to another bank, quote around. But keeping that budget key of mind during this whole process is so important.
Yeah, and keep in mind too, we're about to get into the types of mortgages that you can possibly get. And so as we're discussing those different types of mortgages that you can possibly get, you consider again, how much money do you have saved up? What is your current debt to income ratio? Are you already in debt to about 20% of your total monthly income is going toward debt service already, and you don't even own a house yet? Then what's going to happen when you add the debt for the house on top of that? Because remember, not only are we saying a maximum of 36%, maybe even closer to around an average of 30, but a maximum of 36% debt to income on your house, but a maximum overall debt to income ratio. Total debt that you are servicing on a monthly basis out of your income should be 43%.
Yeah, so it's the whole picture, everybody, looking at all aspects, not just a singular, I want a house, that's all I'm focused on. Look at everything.
So let's jump in.
Let's jump into some of these loan types. So number one that we've got is the FHA loan. And it's popular because of the low down payment and credit score requirements. You can get a FHA loan with a down payment as low as 3.5%, which usually it's around 20, and a credit score of just 580.
That's yeah. When you got a credit score of 580, an FHA loan is a good option for building that credit score up, because 580, it's going to be tough to get anything like that.
Yeah, these loans are backed by the Federal Housing Administration, which means that they reimburse lenders if you default on your loan. This reduces the risk lenders are taking on by lending you the money. And so definitely it's one of those that, this is an option. It's out there. Think about that. Next one, I think really the most common one that I hear about all the time is the conventional loans.
Sure. And it's called a conventional loan because it's conventional.
It's conventional. It's a popular choice for buyers. So you can on this one get as little as 3% down payment, but then there's a kicker with it.
Well, yes.
So if you are putting less than 20% down, you will be required to pay a monthly fee called PMI, or private mortgage insurance, which protects the lenders, not the owner, not the borrowers, protects the lenders in case you default. So this is a flat payment over the term of the mortgage. It's a premium, essentially. It's almost like life insurance.
It's an insurance premium in case you can't pay your mortgage. There's this they have this insurance policy out there that will pay off the loan. This isn't like insurance that they'll like, oh, I can't pay. Here, give me my insurance. No, this is not for you. This is for
the lender.
Thank you.
Yeah. I mean, it's kind of a trick because it's almost like, okay, well, it's okay you don't have court that you don't have 20% to put down. We'll give you this thing called PMI. You're like, oh, okay, sounds good. But, and I've got to say for the most case, because there are some exceptions out there, for the most case, your premium never goes down. It is the same amount you are paying across the entire term of your mortgage. So pretty much instead of you having to have that up front, you're just then now having to have extra added throughout all your payments.
So yeah, hey, I can only make 10% now, but once I build up my equity and I'm above 20% equity in my house, once I own more of my house and have that, then the PMI goes away. No.
There are a couple out there that I researched that do that, but that is the exception. That is not the rule.
So
majority of the time, it stays with you forever,
Okay.
and is like the plague. It sticks to you. PMI kind of is the devil, but just be cautious when you have PMI brought up to you. It is not a fun thing. Next one is a jumbo. This is something that your mortgage is going to end up being above a certain dollar amount. Typically, these are your more expensive houses, and it's going to end up having a higher interest rate because when we talked about with Nancy, you talked to her about the underwriters, there's less people that want to back behind a jumbo because those are it's risky. You're getting a bigger house, and it's a big loan.
Just not to be too repetitive, but one of the things that we're looking at here is banks do mortgages to get the fees, and then they sell the mortgage, and the ultimate owner of that mortgage, they're the ones that are looking to generate that revenue off of the interest so that they have that interest stream for years and years to come. The banks aren't interested in necessarily keeping that. So
that's why it often gets sold. And you're like, oh, where'd my mortgage go?
And when we say it gets sold, there are investors out there that are buying these, and the market for jumbo loans is just not as good as the market for a conventional loan. So that banks have fewer buyers for these things, so they tend to charge higher interest because that higher interest rate makes it more attractive to the buyers that are out there. Which is funny because the first few times that I heard the term jumbo loan, I thought jumbo is good. I like jumbo fries. I like jumbo, planes. I like jumbo houses. Jumbo is good. So a jumbo loan must be good. But jumbo loan is, generally speaking, it's going to cost you more because it's going to have a higher interest rate.
Higher interest rate. You've got to have a 700 or above credit score. So you've got to be a good person with that and have that great credit score. But also it's one of those, the dollar amount that makes it a jumbo it changes depending on your state, but also your county. So in Shelby County, where we are in the Memphis area, a jumbo loan is $510,400. Okay. And so I know we've actually had a client that recently was looking at a house, and the bank that they were working with, they had a great partnership with them. They said, hey, if there's any way possible, you need to try and put more down as a down payment, so more than that 20%, so you can get yourself to a conventional and not have to do the jumbo loan. And so then, that's something that comes into play as well. Now, obviously, that's not always an option. And I mean, if I think in this situation, it was a difference of like $20,000 or $30,000 from a conventional to a jumbo. So they were able to make it work. But if you're dealing with a big difference of $100,000 or $200,000, that may not, you're stuck with the jumbo at that point, probably.
I mean, I certainly would be.
But so that's something out there. A couple other loans that are out there are the USDA, and these are only eligible for people in rural areas. You can borrow 0%, but this is not a lot of us. This is rural areas.
So like farms and stuff?
Yeah.
Because, I mean, isn't the USDA, that's the U.S. Department of Agriculture we're talking about. So this is actually, they're looking to sponsor a very specific kind of buyer out there. Okay. And
same with the VA loans. This is specific to active duty military members and veterans. It's backed by the Department of Veteran Affairs. It actually, it's been around for a very long time. It came out post-war to encourage people to buy houses and really stimulate the economy and get into those suburbs. So it's been around for a while. Interest-only loans, dangerous. Principal
a
is
ghost just walked over your grave or something.
Chills. Woo. Principal is not reduced during this. So just think you are just literally paying the mortgage company. You're just paying interest. And it's useful for home buyers that don't expect to be in their home very long. But borrowers must show lenders substantial assets. And we're not recommending it unless you're in a particular situation. Balloon note doesn't sound as fun as, everyone loves balloons at kids' parties, but that's not what we're talking about here.
Yeah.
I want you to picture that you are on a train track. Mm-hmm. Maybe we're hanging out with Rocky and Bullwinkle, and Boris and Natasha have put up a crazy scheme, and there's a freight train coming right for you, and you've got to save the damsel in distress that's tied up. That is what I want you to picture when we're talking about this balloon loan, because that's kind of what it is. You are working with someone and you've agreed that you're going to have your monthly interest payment or your monthly payments, and you've got it nice and, here you go. Here's your payments and
affordable payments.
Yeah. It works with you. It seems great. 15 years. And so year 1 through 14, you're paying the same amount. Then boom, 15-year, that gets here. That freight train has run straight into you because you now owe the entire amount of the loan left.
Yeah. And to be absolutely clear, you said own, and it was a missed thing. But the reason that I bring that up is because you won't own it if you can't make that payment. You will not own that house. Somebody else will own that house if you can't make that balloon payment, or.
Yeah. So it's mostly interest that you're paying in those monthly payments, and it's a lot of times people have to get this because they cannot afford to amortize, our new word we learned about. They cannot afford to amortize the full note and pay those equal payments. So they're pretty much getting this because they're in a house, or they're getting something. They're putting themselves in a kind of crazy situation, or they're trying to get themselves out of it. But really, you want to try and stay away from this, because then you've got all these payments that you're doing, and then you're smacked in the face with this freight train with $140,000 that you owe, and boom. You could have been spreading this out and making some budget cuts and trying to make it work in your budget. Mm-hmm. This works for responsible borrowers with intentions of selling the home before the due date, but a lot of times I hear a lot of people get into this for not the responsible reasons. Mm. So stay away from balloons. Think of that freight train. Last one that you may hear about is bridge loans. It's a gap loan when you're in between selling a home, buying a home. Mm-hmm. So that's just something to think about if you are in that situation. So let's talk about mortgage terms. We've mentioned it several times, but in today's world, it's 15 years or 30 years. Yeah.
Basically that's all you're going to get is I suppose you could borrow for a lesser length of time if you wanted to, but most of your conventional loans are going to be 15-year or 30-year mortgage.
Exactly. And so the longer term means the lower monthly payment. So obviously if you've got that, then go ahead and do the 30-year. It doesn't mean that you're having that house for 30 years.
Whenever you do move out, it's going to be that you've actually paid less towards your principal if you have that 30-year loan. So when you do move out, you're actually going to have a lower amount of equity in your house than you would have had you done the 15-year. Mm-hmm. So advantage of the 30-year, lower payment on a monthly basis. Disadvantage, you're not building up as much equity. You're not paying off the principal part of your mortgage as quickly.
Yeah. Okay, so, process. I know Nancy really kind of explained a lot of this to you, Court, and we're just kind of reiterating again. It's understanding that you can shop around. You can get pre-approved, which we recommend before you even go house shopping. Go find someone, figure out what you can afford. Remember, just because you may get pre-approved for, $600,000-$700,000 house doesn't mean you have to go spend that. This is not the overachiever thing where you got to make sure you hit what they tell you.
Right.
Get what you need, not necessarily what you can afford. And so say, get your pre-approval. And then when you find that perfect house, you already have the Ghostbusters in there. You made sure it's not haunted and it's a perfect place for you. Then that's where you've got the opportunity that if you've got a relationship with the bank, you can work with them. If you want to price around, just talk to different people, figure out what's the best loan, what's the best rate. And remember, keeping that in mind of your budget, how much you can afford. If you're talking to somebody, you're not liking what they're throwing with you. They're trying to tell you need a balloon note. Mm-hmm. Go talk to somebody else. Get a second opinion.
Listen, the point of getting pre-approval is when you make an offer on a house, you can say, hey, we'll pay you this much and we're pre-approved. And that helps you with the purchase. That helps you with the negotiating in that way. It doesn't mean that because you're pre-approved, you have to go with that particular banker that pre-approved you, or that you have to take whatever rate they've given you. Shop around, find the best rate, find the best fees. Remember, banks are making their money off of fees and then selling the actual mortgage to someone else to collect that interest. So they have to try and be as competitive as they can on fees because they know that you can go to a different bank and get better fees possibly somewhere else. So you're shopping your interest rate, you're shopping your fees. You want to make sure that you really have found the best deal you can.
Yeah, again, I have to drive home. This is such a big decision. You didn't marry the first girl you kissed. Well, I mean, I think you didn't. So I know I kissed a bunch of
it was close,
frogs,
if I'm being honest.
monsters, toads, whatever, before I found my husband. So look at it that way. This is a big decision. Shop around. Talk to different people. Get advice. You don't have to make this decision so quickly. Do your research and figure it out.
Yeah, you're looking at, listen, this bank may be like, well, yeah, we can give you this rate, but we're going to charge you a fee for your points. We're going to charge you a discount fee. The banks have origination fees. All of that stuff, it all plays into, well, I got this great interest rate. Well, yeah, but look at the fees that you paid. And
yeah, that closing cost,
yeah.
Because it's one of those, I remember when I bought my first house, it's, okay, I've got my loan locked in, I've got my interest rate, I know how much I'm doing my down payment. Oh, but what is this? Yeah, all that closing cost, which is the attorney fees, but it's mostly those bank fees. And so figure it out. Take your time. Court the different banks. Haha, like my play on words there, court. You're going to date all these different banks and figure out who's the right one you end up wanting.
Maybe buy some of them some pearls.
Yeah, there you go.
We'll see.
Okay. Big buzzword right now, refinancing.
Is that the big buzzword?
The big word, mortgage
Is that what people
envy.
are talking about?
Me. That's what people are having, mortgage envy right now. I think, around I guess it's not cocktail parties anymore, around the Zoom calls now, everyone's bragging about their interest rate they're getting. And so people are starting to itch of like, ooh, I got mortgage envy. I want your interest rate. And so that's where banks then are like, come on down. Let's see what we can do for you. Refinancing is great most of the time, but
Sure.
You've got to look at the whole picture. You've got to make sure it is right for you. And so kind of the way we look at it is obviously, again, quote, get from different people, talk to different banks, have them run some scenarios. But what you need to look at is, again, with refinancing, you're going to have those closing costs. So you're going to have those attorney fees. You're going to have those big old bank fees. If you can take with the refinancing, look at your savings that you're going to be making, and within 12 to 18 months, you can recover the cost of the closing cost with your savings. Do it.
Okay, so take what you were paying before you refinance. What was your monthly payment before you refinance? Then take what your monthly payment would be after you refinance. And if your monthly payment after you refinance saves you enough money over the course of 12 to 18 months that you can cover all of those closing costs for the refinancing, it's a good deal.
Yes.
Okay, let's go refinance some stuff.
And again, we got to throw it back to when we were talking before about the adjustable rates, that this is where someone would come in and maybe refinance because their credit score is improved. It has nothing to do with you've got a job and started making more money. It's all about your credit score when it turns into about refinancing to try and get a better rate.
Well, I mean, and just to be clear, if you did go out and get a mortgage with a balloon payment before, then you definitely want to look at refinancing.
Oh, absolutely. Like if something was going on in your world and you did have to get a balloon note because it's what had to happen, then yes, when things get
or
better,
interest only, so one of those terrible that we said no, don't do that. Or if you made a down payment that was less than 20% on a conventional loan and you're having to pay PMI. That is a consideration for another reason that you might want to refinance. All of this stuff plays in, but the basic idea is how much can you save and how quickly?
Absolutely.
By refinancing. So I feel like, it's probably as good a place as any to cut this off. We've been talking for a while. Hopefully we've gotten some good meat and potatoes out there to the peoples. But for now, why don't we do a little summary? Katie, why don't you give the people your bullseye?
Absolutely. Okay, my bullseye. First off, so excited that we had Nancy on here to explain all of this. This is fabulous. Buying a house, huge deal. I know I've said it so many times. Really just remember it. It's take a look at your budget. Look at the whole picture of it. know that you've got the opportunity to shop around to really find what works best for you, but also look at it in the sense that if you have to get something for what works for you now, you do have the opportunity down the road to kind of correct the wrong or correct the issue with a refinancing and get yourself in a better situation. So just with all of it, look at the whole picture, make sure you understand everything going into it. What are the terms? What are the closing costs? What is the overall cost to you? And make sure it fits into that budget. So that's my bullseye.
Bullseye. Well, Katie, my bullseye is going to be simple. Be prepared. That is to say,
prepared.
there are a whole lot of moving parts to getting a mortgage and making sure that you get the right mortgage for you. And so make sure that you have all of your ducks in a row and all of your information ready, so you know what it is you're going to need. It all starts, as does everything with us, it all starts back with that very basic idea of a budget. And then you build from there. What is your income? What sort of payments can you afford? What is the debt that you are looking at taking on compared to your income? And then you find the house. And then what kind of loan are you going to get? Well, how much money can you actually afford to put down without spending away all of that emergency savings? You want to know all of that information. You want to have all of that information. And then you want to know what the terms are, what the bankers are looking for, what your loan officers at your mortgage companies or your mortgage divisions of your banks are looking for. You want to make sure you have all that information ready for them. And you want to know what you need to ask them. What are the questions that you need to ask your banker, which would include, well, what sort of fees am I going to be charged? What is the interest rate going to be? So on and so forth. There just know as much as you can so that you can go in.
Knowledge is power.
Find the best loan for you, for where you are in your life, and make sure that it's going to fit with your life. Bullseye. Ladies and gentlemen, you have made it to the end of yet another episode of Bullcast Podcast.
The spooky edition.
The Spooksies edition. If you like what you hear and you haven't already subscribed, please go to your favorite subscription service and subscribe. You can also leave us a comment. We might even respond on the next podcast. If you would like to reach out to us and find out more about us, you can check out our website. That's bullcastpodcast.com. There's some information about me and Katie. You can get all of our episodes there. If you just want to go and click and listen, leave us a comment. Suggest a topic for an episode. We're always looking for topics for new episodes, and we appreciate your feedback. You can also reach out to us on Twitter. Our Twitter handle is @BullcastPodcast. And if you just want to check out some great pictures of me and Katie and that mysterious man, Cameron, check us out on Instagram. That's @BullcastPodcast as well. Finally, ladies and gentlemen, you have heard us mention once or a dozen times that we work at a place called Pickler Wealth Advisors. And if you would like to find out even more about us, we're on that website too, but also you can find out about our awesome team at Pickler Wealth Advisors, our boss, David Pickler, and just general information about our firm and our philosophy. That website is picklerwealthadvisors.com. That's advisors with an O.
Oh. Not an E.
Not an E. I feel like I've given you enough to be going on with. So for now, I'm Court.
I'm Katie, and a PSA, it may be 2020. I may personally enjoy the Sanderson sisters, but please keep the virgins away from the Black Flame Candle.
And Katie, I'm getting out of here because I've got a very important date. I'm having an old friend for dinner.